Okay, with that, okay, let's get started. So now what is an option? It's a contract that gives the option buyer the rights at certain price at a certain time to buy or sell the underlying instruments. So it's just a piece of paper between two parties. Okay, one party receive an option fee and the other party get the rights at a certain price at a certain time to buy or sell the underlying instruments. Now, in fact, most of us actually has dealt with options before, especially if you have bought or sold a property. Okay, so basically, like I said, the options is a contract. Of course, the property options is just a contract between two parties. A stock option is something whereby you can actually buy from the stock market. Okay, but the mechanism, the theory is actually the same. Now, if you could recall, so let's say, for example, today you went for what do you call that? The property purchase. You actually go and search for property. Then you found something you really like, and you decided, okay, I want to buy. So you realize that the first document you sign that the agent will give you is actually this document called option to purchase. Okay, so this is the same option that I'm actually talking about. It actually works exactly the same. Okay, it's just that the stock options is actually traded in the stock market, whereas this option is just between two parties. Now, question time. So probably you have to listen carefully. Now, of course, with option to purchase, you're a buyer, you sell option to purchase. Okay, then you have to pay an option fee to the seller. Okay. Now, then after that, you have 2 weeks later to consider whether you really want to buy the property or not. So as an option buyer, okay, that's you. Let's say you are the one that you pay option fee, you sign the option to purchase. If let's say 2 weeks later, you decided that, yeah, I don't want to buy the property anymore. Is it okay or not? Can you just walk away from this deal? Yes or no? Okay, don't mind, just help me type the chat. Okay, thank you so much. If let's say you're option buyer, you can just simply walk away. Of course, you will lose the option fees. Now, but if let's say you are the option seller, you are the one that collect the option fee, can you within the next 2 weeks and say something like, hey, I don't want to do this deal anymore, I return the option fee to you? Can you actually do that? Yes or no? Okay, thank you so much. You cannot. You cannot. So this is an options. Okay, the rights are actually different. Option buyer get the rights. Option seller actually have the what we call the obligation. So it's actually a different rights for the two party. What is called rights, what is called the obligation. And of course, option seller will actually collect a fee for giving away that rights. Okay, so this is option. So a lot of people always ask this question: how is option different from futures? How is options different from CFD, so on and so forth? This is the main difference. Okay, there is a right and obligation. Okay, whereas if you talk about futures, the rest don't have this concept. Okay, so that is option. So again, like I said, the mechanism works exactly the same as stocks option. So let me give you this example here. So for stocks, if let's say you are interested in Apple stocks, so of course all the prices are not updated. So let's say if you are interested in option stocks, you can just go and buy Apple share, assuming it's $120. And let's say Apple shares price increase to 150. Okay, your ROI is 25%. Why? Because you buy Apple share $120. Okay, you have to fork out $120. You sell, you get back 150. So your share, you actually make a return of 25%. Now, in fact, with options, you can do something quite interesting. So again, I just want to help you visualize. So instead of buying Apple share direct at $120, maybe you can come to me, or let's say easier. Let's say you can go to Seong Yo, and Seong Yo is willing to sell you a call options at $10. And give you the right to buy Apple share at 120. So what it means is this: Seong Yo is actually willing to sign a contract with you. Okay, saying that, okay, Seong Yo is actually willing to sell Apple share to you at $120. So Seong Yo is obligated. you have the right to buy Apple share from Seongyo at $120. Okay, so you have the right, Seongyo has the obligation, and because of that, you actually give Seongyo $10. Now, if let's say Apple share actually go up to 150, what will you do? You will actually run to Seongyo and say, hey, Seongyo, brother, we actually have this contract. In this contract, you must sell Apple share to me at $120. Okay, then after that, okay, so Seongyo have to honor a contract. So with $120, you can actually buy the Apple share from Seongyo, and immediately you can sell to the market at 150. Okay, so in this case, you actually profit $30. Now think of it this way, so what you have done here, because your upfront, instead of paying 120, you only actually pay $10. Can you see? Okay, and if let's say Apple share price 150, you actually make $30 out of $10. So there's an ROI of 200%. 200%. Okay, so ROI of 200%. So that is actually what options can actually do. There is a leverage effect. Okay, now, so why is options able to generate a monthly income? So for stock investor, especially for those who actually use my strategy, okay, ours is actually very simple: buy and hold. Okay, so buy and hold. If a price is low, I buy and I hold for two to 3 years. So for me, a regular income is only dividends, which if you want to talk about having dividends to surpass my work income, it probably not at this stage, maybe in the future years, but not at this stage. Okay, so even you talk about trading, a lot of times actually buy low, sell high, buy low, sell high. It's actually you have to wait for the market to ramp up. Then you can sort of like generate income. Okay, so I'm actually going to share with you how come options are able to better give you a regular or effect a monthly income. So with that, before that, I actually need to go through what I call the 4 basic risk profile. Okay, buying a call, buying a put, writing a call, writing a put. So these are the 4 basic profiles that we actually will run through. Then you have a clearer picture how come options is actually able to sort of help you to make money regardless of the market direction. Okay, so for stocks, very likely we can make money only when the stock market go up. Okay, in terms of monthly income, regular income, okay, we can make money when the stock market go up. Whereas for options, you can actually make money from both directions. Okay, so I'm actually going to explain this 4 basic risk profile and go into detail very soon. Okay, before that, I need to explain this thing called the payoff diagram. So this is very important, especially for those who eventually want to do option investing. So this is one diagram you must learn. Okay, one diagram you must learn called option payoff diagram. Okay, now, how does this payoff diagram work? You have the x-axis. X-axis is the price of the underlying asset. Okay, by the way, just to be clear, options is options, stock is stock. Options is also called derivative, which means to say by itself, it has no value. It derives its value from an underlying asset, which is stocks. So they are actually 2 separate things altogether. Options is traded in the options market. Stocks is actually traded in the stock market. Okay, hopefully that's clear. Okay, now let's look at this payoff diagram. Okay, so as I mentioned, x-axis is the price of the underlying stock. Y-axis is your profit and loss. So let's say, for example, you just do a plain vanilla buying the stock. Assuming the stock price is actually $55. Okay, you just do this buy a stock only, has a simple buy low, sell high. So you actually buy the stock at $55. If the price of the stock increase, you make profit. If the price of the stock drop, you actually make a loss. Okay, so that's what the payoff diagram show. Now, let me introduce you to this thing called the call option. Call. Call. So again, all these are technical terms. All these are technical terms, not because I call them is technical term. Call option. What's the call? The call gives you the right to buy the underlying instrument. Buying the call gives you the right to buy the underlying instrument. Okay. So how does this work? Using Payoff diagram is actually a lot easier to explain. So assuming now the underlying stock price is actually $55. Okay, the call premium, which is the price of the option, is actually $5. So like for example, now Seong Yo is actually willing to sell an option to you at $5. And with that, you can actually buy the stock from Seong Yo, the underlying stock from Seong Yo at $50, which is what you call the strike price. And in options, there is an expiry date. There's expiry date. That doesn't, the contract cannot be forever. There's actually expiry date. So once again, this is how you read it. Assuming now the stock price is $55, that's underlying stock price. Okay, there's Seong Yo is willing to sell the option for $5, or you can actually buy a $5 call option from Seong Yo at $5, and with that call option, you can actually buy the underlying stock from Seong Yo at $50. Okay, that's what the contract does. Okay, now so this is what happened here. So if let's say, for example, at $55, okay, question time. Assuming the price increase, the price go up to $70. Will you actually run to Seong Yo and say, hey, I want to exercise my option. I want to buy the stock at $50 from you. Will you do that or not? Yes or no? Okay, here's the question. So of course, 55, you actually have the buy a call option and price increase. Thank you so much. Yes, you will actually want to exercise the option. So this is what you do. If let's say price go up to $70, you run to Seong and say, hey, brother, you say I can buy for $50. You fork out $50 and buy the stock from him. Then immediately you sell to the market at $70. Okay, you make $20. Then of course, minus the call premium you paid to Seong Yo initially, you actually make $15 from this deal. Okay, now at the same time, let's say for example, the stock dropped to $30. Assuming the stock dropped to $30, will you go to Seong Yo and say, I want to exercise my option or not? Yes or no? Okay. Hey, thank you so much. Great. I think we have a very knowledgeable crowd here. Thank you so much. Yeah, no, because if you actually go exercise, you have to go and buy from Seong Yo at 50, but you can actually buy from market at 50. Sorry, you can actually buy from market at 30. So why would you actually want to buy from Seong Yo at $50? So you will let this option expire, worthless, and your loss here in this case is the $5 you actually paid to Seong Yo. Okay, that is your maximum loss. Okay, the option will be worthless, useless, and the maximum loss is actually $5. Okay, so this is the interesting thing about options. You can also be a call seller. Doesn't mean that you always have to buy first. Okay, like for example, stocks. Of course, stocks you also can sell them, buy back later using different instruments. Okay, but for option, you can be a seller and you can be the one collecting the premium. So this is what happened here. So let's say, for example, you are the option seller. Okay, you actually collect this $5. You can actually collect up this $5 first. So that is the interesting part of options, and this is also the reason why options can actually give you a money income, because you can be the option seller in this case. Not necessarily you have to buy something first. Okay, so you can see the payoff for a buy call is just the opposite of a sell call. So whatever the call buyer make is the loss of the call seller. Okay, and vice versa. So this is probably the payoff for what Seong Yo. So just now Seong Yo sell the call to you, right? Okay, if the price increase, what's going to happen? Seong Yo need to go to the market and buy the stock at $70, for example, and sell to you at $50. So in that sense, Seong Yo lose $20. Okay, and when the price drop, okay, you are not going to exercise the option, then Seong Yeo will be very happy. He just keep the $5 premium. Okay, now there is one very important thing that I need you all to pay attention to. Okay, there's actually one word. If you eventually go to option investing, you must have in your mind this word called naked. Okay, I'm not trying to be naughty. This is a technical term. This word called naked. Okay, let's say Seong Yeo just sell a call and don't have the underlying stock. This is what we call a naked, selling naked call. And which means the loss can be unlimited. Can you see? The loss can be unlimited now, which is very scary. So in fact, Seong Yeo just last week show us a post. This guy, there's actually this guy, I can't remember, is it selling naked call, naked put? Okay, make a loss of $600,000 in a matter of, I think, 2 hours. 600K, lose 600K in 2 hours. And Seong Yeo has his own personal experience to share. So don't always think that, oh, never mind, the price confirm won't come down or price confirm won't go up. So please, please, please never go naked in options investing. I cannot stress enough. If I repeat it all the times, I'm sorry, but important things have to keep repeating. So never, 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 never go naked. Okay? So in fact, this is the main reason, because a lot of people say that, hey, well, I just make $5. That's quite short. What? I don't do anything. I don't need to put money out front. I just make $5. Very tempting, right? Okay. But the loss can really kill you. That is something you have to take note of. Okay, so this is calls. Calls give you the right to buy. And of course, you sell calls, you're obligated to sell. Okay, there's actually this thing called the puts. Called a put. Now, buying puts give you the right to sell the underlying instrument. Okay, let's have a bit of comparison. If you buy call, give you the right to buy the underlying instrument. If you buy puts, give you the right to sell the underlying instrument. Okay, that's the difference here. So again, let's walk through this example, then probably it's clearer. So assuming you actually buy a put from Seong Yeo, same thing, stock price 55, put is 5, strike price is 50. So let's say you now the price is actually $55. You actually buy a put from Seong Yeo, and with the put, you have the right to sell Seong Yeo the stock at $50. Okay, if the price increased to $70, would you actually run to Seong Yeo and say, Seong Yeo, we have this contract. I want to sell the stock to at $50. Would you do so or not? Yes or no? Like, yeah, answer is no. Okay, if you can sell to the market at $70, why would you actually want to sell at 50? So in that sense, you will actually let the option expire. Okay, and the reverse will hold true. The reverse will hold true. If let's say, if you buy, if you actually buy a put option from Seong Yeo, buy put option from Seong Yeo, so assuming that the price dropped to $30, okay, you would actually want to exercise. Why? Because you go to market and buy at $30, and you can sell the stock to Seong Yeo at $50. Okay, so that's what the put option does for you if you actually buy a put. Okay, in this case, you can see that the payoff is actually the other way around. So let's compare. Okay, this is the payoff for call. Okay, you make money when the price increase if you buy a call. This is make money from put. You make money when the price decreases, as you can see here. Okay, so probably now you can have a better understanding. How come options is better able to give you a monthly income? Because basically you can profit from both ways. Market up, you also have strategy for it to profit. Market down, you also have strategy for profit. Okay, not only that, you can also be an option seller. You can collect the fees instead. So with all this different mechanism, that's why relatively to stocks, options can actually give you a monthly income. So I always say, if let's say you want to be a full-time options investor like Xiong Yo, really take it as a full-time or part-time job you can through options. If you use my stock strategy for monthly income, that one, okay, unless you have very big capital, then you actually make money from dividends. If not, generally speaking, that's why my course is called Create a Secondary Income. Okay, so this one, you know, that is actually a possibility to make it like a primary income. Okay, so again, sell puts is just a reverse. Sell put is just a reverse. Okay, whatever that the put option, the put buyer make is the loss of the put seller. Okay, vice versa. Okay, so again, this part is also naked. Never go naked. Never go naked. So of course, later I'll tell you how to cover yourself, how to cover yourself. Okay, but again, if you just sell put alone, you can actually have unlimited loss. Okay, if the price drops. Okay, I want to talk about the various strategies that options can do better than stocks. So of course, I'm not saying stocks cannot do all this. Okay, but it's easier for options to actually implement all these strategies, again, which can help to generate a monthly income. So let's say, for example, you know, down market, how can you actually profit from down market? I believe I have already shown some examples. So number one is you just buy puts. As you can see here, you buy puts. So this is similar to what I've shown just now. If you buy puts, when the price drop, you actually make money. Okay. The other one is actually what we call a covered call. Okay. So how you make sure you don't go naked is to have a covered call. Okay, now, of course, let's say when the market is down, okay, to make money, you can just sell a call. Okay, sell a call. So if you sell a call, unlikely for the option buyer to exercise, and you will just keep the premium. Okay, but of course, as I said, no, this one can be dangerous because you have unlimited loss. You have unlimited loss. Okay, so to prevent this unlimited loss, or you know, to prevent getting naked, how you cover? You cover by owning the underlying stocks. Owning the underlying stocks. Okay, now let's look at a bit of mathematics. So assuming now that current stock price is $50, okay, you buy the stock at $50. Okay, then after that, you actually go and sell the call at $5 with the strike price of 55. Okay, that means people can actually buy the stock from you at $55. Down here, sell the call with strike price of 55, buy the stock at $50. Okay, if the price drop to $40, okay, the options will not be exercised. You make a profit of $5 from the options, and for the stocks, you actually lose $10. Okay, you all may be wondering, like that, net, I lose what? Okay, so this is actually in terms of what they call investing strategy. It works like, for example, so let's say, for example, people like me, when I buy stocks, actually, you know, my ideal state is I can actually pass. I don't have intention to sell one. I want to keep my stock for my daughter. In fact, the best actually for my granddaughter. I have no intention to sell. So let's say while I own this stock with the purpose of owning over long term, and if let's say I want to make a little bit of extra money, I could actually sell a call. Or put it this way, let's say I buy a stock, I have no intention to sell. Then I think that the stock price is actually going to correct. In order to make a little bit extra, I can actually sell a call. Okay. So if let's say indeed the price drop, okay, I actually have no intention to sell anyway. Okay, so to me, it's not really a realized loss. Or put it this way, I think that this stock confirmed long-term will gain one. Okay, so in that sense, okay, this is just paper loss. Okay, to me, if let's say I'm a long-term investor, to me, this is not meaningful. Okay, this is not meaningful. and I will just happily make extra $5. I'll just wait. Okay, I just wait for the price of this stock to go back up. Okay, so the other thing that, of course, options can do is earn fixed income. So we actually talk about it. You actually sell call to actually earn this premium. Of course, you don't just sell call naked. You actually do a covered call. Okay, as per what I explained just now, then you actually make this $5. So if you actually think that the price is actually going to go down, okay, and you already have the stock, maybe I just sell the call to make this $5. Okay, even when you do this, and when the price increase, okay, when the price increase, okay, the exercise, then you have to give away your stock, right? Okay, even you do this, you may actually still make money. You may actually stick money when the price increase. Okay, again, let me just go to this example. So just now what we have been talking about is when the price drop. Okay, when the price increase, so let's say, for example, same thing. You sell a call, strike price 55, you buy the stock at $50. If let's say price increase to $60, okay, you exercise the option. So option $5 you will always keep regardless. And the stocks, okay, you buy at the stocks, you actually buy at 50, then you sell at 55. Okay, so you still make another $5. Okay, so in that sense, if let's say if you are wrong, you think that the price will drop, but in the end it actually go up, you still can make but of course your profit is actually capped at this $10. Okay, your profit is actually capped at this $10 because you have to sell at 55. Okay, but you still make money So of course, when we talk in terms of collecting fixed fee, besides selling call, you can sell a put. Okay, now in this case, sell a put. How do you actually prevent yourself from being naked? Okay, you prevent yourself from being naked by getting ready to buy, having the money set aside to buy at the strike price. Okay, that means you already have the intention to buy the stock at the strike price already. Okay, then you won't be naked. You have the intention, you have the money to buy the stock at strike price already. Okay, so let's just go through this example, it's clearer. So let's say current stock price is $55. You sell a put for $5 with a strike price of $50, which means in this case, you are already ready to buy at $50. So if let's say when the stock price increase, okay, when the stock price increase, they won't exercise the option. You keep the $5, you make money. But if the stock price drop, okay, let's say the stock price drop, okay, for you it's okay because you're already prepared to buy at $50 and you have the money there, or you don't mind buying at $50. Okay, so in that sense, yes, the price dropped, but in the end, you actually own the stock, which maybe you're happy about it. Okay, at the same time, you still keep this $5. So this is prevent yourself from getting into a naked put. Okay, the last thing that, or at least from my knowledge, the last thing that options can do is to protect your downside. This is again something actually very interesting that options can do and stocks cannot, which is simply like, for example, buying calls. So just now I give the explanation. So let's say you think that the stock is going up, you can just buy a call. If it indeed go up, you make money. If you are wrong, the stock go down instead, you actually just cap your loss at $5. So that's actually something quite interesting. You actually cap the loss at $5. So unlike, let's say you buy a stock, then after that, oh no, you are wrong, then you just bear the maximum loss. In this case, you actually can cap your loss. So it's like, buying an insurance, $5 insurance. Okay, so these are the various risk profile, and of course, the various things that the options can do better than stocks.